So, a lot of people on this call probably know Charles Lemire. Not nearly as many as Charles. I think Charles has invested in over 70 deals at this point, all as an LP.
Welcome everyone to our Hero Capital Show. I'm your host Tim Mai, and today I have another amazing guest on the line with us, Mr. Shawn Griffith. Shawn is the CFO and co-founder of Kraft Capital Investments, a firm that specializes in alternative investments in the Dallas-Fort Worth multifamily market. And Shawn began his capital raising journey with zero network, zero deals, just a strong belief in the power of real estate, being able to create lasting wealth. And over the years, Shawn has grown from investing in small multifamily deals to managing fund of funds and deploying capital across private debt, equity, real estate syndications, oil and gas, and also triple net leases as well. So, everyone, let's give Shawn a huge Texas welcome. Woohoo!
Thanks, Tim.
All
Always
righty,
love
Shawn.
stopping in to chat with you.
Yes, well, likewise, I'm always enjoying our conversation. So, yeah, if you can share with everyone a little bit about you and what got you into this world of real estate to begin with.
Oh, wow. How much time do we have? Let me give you the short version. And then if we have time, we can talk more later. I started about, I don't know, 14 or 15 years ago. I saw some young faces on there when we were introducing here earlier, and I wished I had gotten started at their ages, but I didn't. But I'm doing okay now. A friend of mine invited me to one of these weekend seminars where they're going to talk about real estate. And the first day they talked about single family and how you can be free with 10 single family homes. I'm a math guy, so I did the math and I'm going, okay, it's probably more like 15 because you got to have a buffer in there. And anyway, the next day they talked about multifamily and I'm going, oh, that makes way more sense. For about the same amount of work, more up front, less in the middle, you can get into more units. And I wasn't ready to take the plunge as an owner operator at that point, but my friend that had invited me was. And we got into this little 64 unit deal over in Carrollton, Texas. At the time, it was called New Orleans. And my buddy absolutely crushed it, completely spoiled me. We got 3.5 times our money back. It cash flowed
Nice.
12 to 14%. And now I'm expecting every deal should be like that. No better now. That was like a unicorn deal. That's like looking for narwhals when you're at sea. It's just the likelihood of you seeing that is small. And that's where I got started.
Good start. That's good. Oh, so when was this?
This would have been, let's see, this is 2025, so probably around 2011, 12-ish.
Oh yeah, that's you can't find a better timing
Oh yeah.
than that.
Yeah,
Yeah.
if you could fog a mirror, you could make money in real estate at that time.
Yeah, I remember the last market crash. It wasn't just affecting single family homes, but it affected multifamily. I met some people that were buying multifamily straight from the banks with like hard money loans at 14% and still able to cash flow, still able to make it work. It was insane time back then. Yeah, so from there, that led you into this world of real estate, and I know you've acquired now over $80 million worth of real estate. And so share with us a bit of your journey. What have you been seeing, and with you now expanding beyond multifamily into other assets, give us a sort of an insight into your path of growth there and where you see yourself going.
Sure. I'll skip over a lot of the boring passive stuff and we'll fast forward to November of 2020. And
Okay.
I was still mostly passive at that point. And we'd invested in some deals. At that point, all of them doing pretty decent cash flowing and everything. And then my wife and I, we were looking over our finances and we go, we're going to have an okay retirement, but who wants just okay? We want to be able to step it up. And if you see my background here, that's actually Antarctica. We love to travel. And so we want to be able to travel like this 2, 3, 4 times a year. And to do that, we were going to have to ramp up our game. And to do that, we looked at a bunch of different options. Short version is we ended up picking real estate syndication, and we dove in head first, and that's how we got started with that. I was a GP on my first deal November of 2021. Since then, I've been a GP on about 5, soon to be 6 other deals. We've got one
Very
that's
good.
under contract, should close here September 8th. Sorry, I can't take any more investors. We're already full.
Good
Darn
problem to
bullets.
have.
I know that's a good problem to have. We do have other ones in the pipeline. And then just looking at some of the other things that we're doing. So I had my own company at that point, TWT Multifamily. Since then, I've merged with, excuse me, with Gabe Kraft and at Kraft Capital Investments. He and I had done a couple of deals together, and we kind of liked each other. And we said, you know what? Let's make this a little more formal. So I'm coming in and helping Gabe and the team pick up from where they're at and move forward. Gabe has this huge, amazing vision, and way more than I ever would have even thought about undertaking. And I'm just in the position to help him get there. I do what I can to help the team. I used to say in my career when I was in IT, I was the team lubricant. I did everything that made the team run smooth. If that is go and troubleshoot this one issue, or go track down this one person to get a requirement, or hey, you need me to run get donuts to keep the team happy? Great. Whatever it is, I do it to make the team happy. So
That's
we're looking at growing from where we are, which is a multifamily syndication business, into a $1.5 billion company in 10 years. And quite frankly, that kind of scares me. The goal we had before didn't really scare us. We looked at it and go, okay, yeah, that's pretty achievable. Now this one scares us. So we decided we needed to up our game. Anyway, the way we're going to do that is we're going to grow across multiple verticals. We've already got an offering for a triple net lease. It's in a very specific niche market of cannabis leasing. We've got we're looking at exploring like a small batch whiskey offering. That's in the due diligence phases.
interesting.
I'm looking forward to tasting on that one. And just from a fund of fund offering, on this last deal that we're closing on September 6th, we kind of trial run our fund to fund process where we had a couple of people that were interested, and we helped them get started and set up their fund and bring investors in and come into our deal. And then we're looking at growing that model to be able to people that can raise. We're looking at a minimum of around like 400 to 500K as a minimum target we want people to be able to bring in before we go, yeah, we're going to work with you. Because we typically are working with high net worth people that if push comes to shove, they can write that check themselves for the commitment. But the whole idea is we work with them and show them how to make money, raising money, and do it legally so they can bring in the fund, and then their fund invests as an LP in our deal or
That's
in some
good.
of our other fund offerings.
Yeah, that's good. That's a strategy a lot of experienced operators are leveraging right now for sure.
Yeah. Yeah.
So from your first LP deal to your GP deal, how many LP deals did you invest in?
So a lot of people on this call probably know Charles Lemire. Not nearly as many as Charles. I think Charles has invested in over 70 deals at this point, all as an LP. He's a
Wow.
complete and total LP. He doesn't do. I have invested, my wife and I have invested in LP deals. I think we're up to 17 or 18 right now.
That's still substantial. Yeah, that's good.
Yeah, yeah. I call it a good start.
Yeah. And then now that you're starting doing GP, do you still invest purely as an LP into other people's deals, or do you just invest into your own deals?
Mostly our own deals at this point, but that's because I suffer the curse of the real estate investor. I look great on a balance sheet, but I don't have any cash. And to invest in other people's deals, they want you to have cash. I don't have Trevor's good looks, so I can't trade on that to go, hey, here, I'll offer you my good looks and you'll give me equity share. No, it doesn't work that way. But no, we do still invest. We do have a couple of investors or operators that we really like. Well, okay, my wife really likes because she has a pool of money and says, okay, this is for so and so's deal. You can't touch that.
Wow. So give us with you having, having invested 17 deals as an LP. Let's start with that journey. What is, especially in the beginning, like earlier on in your journey as an LP, how did you decide what deal to get into, who to invest with? Yeah, and yeah, we'll start with that, and then we'll go into if any of your deals gone bad and you lost money on them. I'd like to hear what went wrong on those deals as well.
I don't know if we have enough time today, Tim, but what you heard about my first deal, I got into
Yeah,
that because a friend invited me in. But one of the pieces of that story is he sent me the PPM, and this was back in the days when the PPM and everything was still about 40 pages. Now they're like 100, 120. And I read through it, and quite frankly, it scared the hell out of me because there's a lot of legalese garbage in there. I didn't really understand it. And he goes, you know what? He goes, look, he goes, since this is your first one, he goes, you should really sit down with an SEC attorney and have them explain it to you so that you're comfortable with the document. And I'm going, okay, that makes sense. It's a legal document, get legal expertise. Just makes sense. I sat down with one of our local SEC attorneys that almost everybody on this call probably knows, but he doesn't really do much attorney work anymore. I refer to his office staff as his minions. They do all the work now. Anyway, he sat down with me, $500 flat fee, reviewed it, confirmed that yes, it's
that's
a
cheap.
valid document. Oh, he goes, yeah. He goes, you couldn't get me for 4 times that now. And anyway, he reviewed it, went through everything, and I still remember he came out, he had like little tabs on everything, and we took an hour and went over everything until I was comfortable with it. And there's this one section, there's about 14 or 15 pages of stuff that reasons you should not invest in this deal. And he said the only reason that should scare you is if it's missing, because then they're trying to hide
Hmm,
something. He goes, what that should prompt you to do is go, hey, Mr. or Mrs. Sponsor, how are you mitigating all of these risks here in these 14 or 15 pages? And honestly, it comes down to about 80% of them are having the correct type and amount of insurance on the deal. The other 20% is doing a very thorough physical due diligence on the property so you know what the heck you're getting into.
very cool. Okay. And yeah, and going beyond that deal, yeah, share with us a bit of your journey of, okay, what are some other deals that you invested in, why you invested in it? Yeah.
So that the first guy that I invested with, a good friend of mine, Jason Sharp, he doesn't do multifamily anymore. Matter of fact, we just divested the last multifamily property we had. It was out in Abilene. It was almost 500 units. And we had owned that since 2016. We, I think after everything's said and done, we didn't quite triple our money on that one, but it was a nice run.
That's good.
The So I invested in another deal or two with him. I got into a couple of other deals with people that I met. And then if you fast forward to November of 2020, where we were talking about where I got in,
Yeah.
and we got into another community and got involved with some of those people and got to meet them and learn who they were, invest. And
Gotcha.
we've invested. One of the things we look at is how many deals they've done, how transparent are they? And yes, I have had deals that have not done well. I have a deal we were invested in out in Tyler, Texas. We lost 93%, I'm sorry, 91% of
Hmm,
our investment. Now, honestly, I think it's going to be more than 100% when everything's said and done and we get everything closes out. Because when the year-end taxes come and we have depreciation recapture, I think we're going to have another loss on top of that.
I
Uh,
see. So what went wrong in that deal?
a variety of things. The owners and operators were not local. They had success in other areas like Nashville and Dallas, where they are also not local, but they had a good team on the ground. They didn't have a good team on the ground out in Tyler. That was part of it. Part of it was they bought at the top of the market. Part of it was they had, I don't want to say bad debt, inappropriate debt. It maybe is. I think you all know what I'm talking about there. It's floating rate. They had a rate cap, but it's 3 years. And when you get to the end of that 3 years with the two 1 year extensions, guess what? There's no bank on the planet that's been granting people those, or very few people have gotten that 4th year extension, not without some modifications and cost, because the
Right.
banks realize that, hey, we're not going to make any money here, so we're not going to let you have the extension. So you either have to either refinance through us or refinance through somebody else. And it just wasn't tenable. To their credit, the GP team put in over 800K of their own money to try to keep the deal floating, but they just wouldn't work. And they're good operators. I know all three of them personally, and I know all three of them. But yeah, it's just not everything goes your way all the time. Unfortunately, everything stacked up against them all in one big chunk there.
Right. Yeah. It happened to, and it's still happening to a lot of operators, right? Some of the people that I know, they're as successful as it comes, and they too get hit with some of these deals that they can't navigate their way out of it for whatever reason. And yeah, so it's happening a lot. I think that coming up here in 2026, we're gonna see even more. I mean, we're already seeing quite a bit here in 25, but I think that toward the end of 25, beginning 26, we're gonna see even more deals that's gonna where the operators just can't hang on anymore. They hang on for as much as for as long as they can. They inject as much more money in as they can, and they can't kick the can down the road anymore. So yeah, they're coming to that time now where it's okay, we're just gonna have to cut our losses and move on, kind of thing. Are you seeing a lot of that?
Not a lot, but it's definitely there. A lot of people, they're in deals where there for a while, everybody was calling it the extend and pretend phase.
Yep.
And I've got a deal that we're selling. We're going to be able to return 70% of the investor's money because we looked at it and go, based on the investment that we would need to make to refinance it, because we would have to refinance it. Extending it for a year is not really an option, because in a year, and honestly, if we stop and think about it, it's 9 months. It's not a year, because you've got to start that next cycle 3 months in advance so you can get the next extension. And if you could get a 2 year extension up front, maybe that would work. You really need a 3 year just to give yourself the runway, because nobody knows how quickly or slowly things are going to recover. I know everybody's hoping for that 2021 rocket to the moon pricing. Not going to happen, in my opinion. Again, I'm not an economist. I don't play one on TV. Can't tell you what's going to happen, but that's just my opinion on what I've seen so far.
With you having started as an LP and now a GP, and get to see other operators that you have invested with from a LP perspective, has it given you ideas and things to do, things not to do, to make sure that you're well taking care of your LPs? Yeah, give us some of your insights from that perspective.
Yeah, one of the big ones is, if you don't understand the debt on a deal, you are at a disadvantage, whether you're a GP or an LP investing in it. You've got to understand, and I don't mean you've got to become an expert on debt. You don't need to be a Paul Peebles or an Anton Mighty or any of those, right? But you need to understand. Yeah, I liken debt, it's like a power tool, right? Like a chainsaw. If you know how to use it properly, it's great for cutting up limbs and stuff. If you don't know how to lose it properly, you're probably going to lose a limb. And honestly, debt's the same way. If you have the wrong debt or you don't understand the tenants in your lender documents that go, hey, if you don't do A, B, and C, then we're going to do D. I mean, you need to know what consequences, what kind of teeth that lender document has. Now, does an LP need to know that? Maybe not, but the LP needs to at least know, hey, if this is short-term debt like a bridge note, what's your plan, Mr. Mai, to get us out of this bridge note before it runs out? And you as a sponsor need to have an answer to that. So how I protect my LPs is we try to look at that going in. And some of this is stuff I've learned just in the last few years. So it's a continual learning process, right? I have to take feedback, the good, the bad, and the ugly, and roll that all back in and go, okay, next time we do this, we're not going to do the other thing. Now, all that being said, you can probably tell I'm not a huge proponent of floating rate debt. It has its place. It's like any other tool. If you're picking up a really ugly property and you've got to do some significant maintenance on it, and it's below the threshold of occupancy that Fannie and Freddie want to see, then yeah, you're going to have to go with agency debt. I'm sorry, you're going to have to go with bridge debt. But you've got to have a solid plan when you do that to finance back out of that. And you can't make assumptions about, oh, the interest rates are going to go down or the interest rates are going to stay flat. You've got to be able to have a plan that fits the worst case of, I'm going to be able to get out of this floating rate debt in 2.5 years, pretty much no matter what the interest rate is. And yes, that'll affect the long-term returns, but anyway, I could go on for hours about this.
It's yeah, understanding that is definitely a really big part of the equation for sure. And so share with us now, you're starting to expand beyond multifamily to hit your goal of $1.5 billion. Is this billion asset under management, or what does this $1.5 billion number represent? And why? Why 1.5? Why not 10.5 billion or whatever else it could be?
The 1.5 scared us enough. I think in 5 years we may adjust that, Tim. But for now it's the 1.5. And as to the why of it, I'm going to throw that in Gabe's lap because he's the visionary. We're in the process of implementing the entrepreneurial operating system.
Yep.
Gabe's role is visionary. Our other partner, Misha Kaufman, is integrator. I jokingly refer to my job as chief cook and bottle washer. Again, I do whatever the team needs to get stuff done. I manage our cash flow portal. I'm the de facto COO or CTO, chief technical officer, chief information officer. And it's funny that Gabe gave me the title of CFO because I don't have a degree in finance and I can barely spell treasury. But and the funny thing, Gabe and I both talked about it. We both agree I am not the right person in this role for the long term. We're on 100% agreement on that. But I'm the right person now because I'm getting it. I'm keeping everything moving. I keep pushing. I keep trying to formalize our finance area and get all that stuff defined and put all the processes in place. But to get us from where we're at to that 1.5 billion, I think initially we were looking at that as assets under management.
Okay.
We're going to be buying some other companies. And these are going to be companies in verticals related to multifamily support, at least initially. Things like painting, electrical, plumbing. We've started our own construction company. It's going to be a GC operation where we use the relationships that we have to pull in people as needed for different jobs. And it's going to be more of a management oversight type role, not a full-blown construction company. Where that goes, Not 100% sure yet, but we're working on expanding across multiple verticals, including, and one of the options may be is we may have a fund that lets people invest in business acquisitions, and we'll treat our businesses that we acquire just like our multifamily, and we'll be doing monthly reports out to the investors on the status of the business. Again, there's still a lot of work to be done. And then I think Logan mentioned at the beginning, he said something about, hey, if you're not using AI, you're probably behind. I'm going to correct that phrase just a little bit. It's not probably you're behind, you are behind. I was
Yeah,
at the World Finance Forum in Dallas, and one of the keynote speakers started off her speech going, AI is not here. Or no,
so
it
many
wasn't.
good.
I'm sorry, she
Not
said AI
coming.
is not coming. AI is not coming. It's already here. And
Yeah,
if you haven't been looking at it, you are way behind.
yeah, I agree. And it's moving so fast,
Oh, I
so
know.
fast. It's incredible. Do you happen to know why is it that you guys are to hit your goal of $1.5 billion asset under management? Why aren't you going all into multifamily? Some of the operators in our industry have gotten. What have you
Yep.
guys decided to not only go into other real estate assets, but you're going even outside of real estate?
No, that's a great question. Part of it is because conversations we've had with our investors is they want other things to invest in. They still love multifamily for the long-term wealth protection and accumulation, but I think anybody here that's invested in multifamily would agree that the bulk of multifamily deals are not cash flowing like they used to.
Correct.
And you have investors like me that are, we'll say, a little more chronologically gifted than others that are looking at things. We want stuff that cash flows because, as my good friend Mike Guthrie says, he goes, yeah, you can't eat net worth.
Yep, exactly. Yeah, that's for sure. Okay, so you guys going into different verticals. Part of that reasons is because that's what your investors are looking for. And that is definitely a strategy I see a number of sponsors do as well. So that they're like, okay, I want to be able to provide like a well-rounded portfolio for my investors so they don't have to go somewhere else. They can do all the
Exactly.
investments here with me. So let's talk about your investors, your LP investors. Who are they? Where? How did you begin to build your investor database as you became a GP and started raising capital?
Oh, wow. I probably started like a lot of people do, going to real estate meetups and handing out thousands of cards, 98% of which end up in the trash somewhere. And then I realized that it's not about just making that initial connection and realizing that most investors aren't investing initially in the deal. They're investing in you as an individual. And for them to do that, you've got to earn that trust. And just handing them a business card doesn't do that. So fast forward, I still go to real estate events. I almost never hand out my card anymore. I just start up conversations. And then if somebody asks me for contact information, I pull up my phone and, oops, I pull up my phone. You probably can't, it's fading in and out, but it's got my QR code on the front that takes them into my CRM, just like you do.
Gotcha. Okay.
And then from there, we continue the conversation. I don't
Right.
hammer them with what deal I've got going on. If they ask, I'll say, hey, we've got one that we're going to close on September 8th. We don't have room for any more investors right now, but we've got other deals in the pipeline. Happy to talk to you about the process if you want to learn more. I'm not a hard sales guy. We look at it. One of the things we look at Kraft is we want to have that trust relationship with our LPs. Gabe likes to use the term for transparency, accountant in a glass sphere. He wants that 360-degree visibility on everything that we're doing. So our books are open. Investors, if you're invested in one of our deals, if you haven't seen the books, that just means you haven't looked because we make all that stuff available.
That's good.
And now, do we give them the general ledger? No. We don't give them the rent roll because it takes time to go and sanitize all that because you've got your residents' names and phone numbers and stuff in there. Nobody wants that stuff floating out because that's a whole nother problem. But we give them the rent roll and the balance sheet and let them know, hey, here's everything that's going on. We do monthly reports. So it takes time. I was telling you about my friend Mike Guthrie. You've probably heard his story. His very first raise, I think he raised $4 million. And everybody goes, oh, wow, first raise, $4 million. He goes, oh, yeah, it took him 28 years to get there because he was in business for 28 years doing his ATM business. And he had literally thousands of business owners in his phone as connections that he had already built trust with as a business owner. And all he had to do was tap that and go, hey, I didn't have that. So I had to build mine more slowly. And I did it by just getting out, meeting people, making the connections. Some of them are people I used to work with. Some of them are people I've met at real estate events. Some of them are people I've met on LinkedIn. Some of them are referrals. I asked my CPA, I talked to him about what we do. And I said, hey, first I asked him, I said, are you open to me referring people to your business? And he goes, sure.
Of course.
After about 6 months, he asked me to stop because he'd run out of capacity.
Oh,
He had to add more people. Now, since then, he's turned it back on, so I can still refer to people to him now. And then in return, I didn't have to ask him for referrals. He just sent them to me. So it goes back to that. And this is something you're really good at, which is giving value. You just offer value. Eventually, it comes back around. Sometimes it's not as quick as we'd like, but it happens. You just have to give that value and provide value to people, even if you know they're never going to invest with you. Because they may never invest with you, but maybe they have a rich uncle that will. You don't know.
So from your various channels there, you talked about networking, you're talking about past coworkers, you're talking about LinkedIn, you're talking about CPA referrals. Is there like your one or two top channels that you like the most? Either A, because they're where you've gotten the most of your investors, or where your biggest investors came from?
I think some of the real estate events I've been to, I've gotten some pretty big investors from those because you'll have people that are out there that are looking at this. If they're looking at a syndication deal, they realize the value in that, but they also, especially if they're business owners, they also realize that that's another full-time job. And once they make that realization, they go, you know what? I don't want to be a GP myself, but I want to partner with somebody that's getting out there and doing it. And so I think for me, the real estate events are my top one just because that's where I've gotten some of my higher dollar investors. Our investors run the gamut. We've had people invest as little as 10K all the way up to, we've had a couple of people write $1 million check. I wished I had more of the $1 million check guys. Again, it's a process. We're growing it.
That's excellent. Wow. Okay. So your key to making the networking events work, like you mentioned, is meet them, get not just exchange business cards, but really get to know them at a deeper level, build that deeper relationship. And that's been what's working well for you in your capital raising. Is that correct?
Oh, absolutely. And just to be clear, I didn't start off that way. I was the spray and pray guy. I'd get out there throwing out business cards left and right. And then after I learned that activity is not a value add to me, Once I realize that, then I'm going, okay, it makes more sense to focus on things that do result in actual investor conversations.
It makes sense. Yeah, for sure. With all the deals, so how between LPs and GPs, how many deals do you think you're in right now currently?
If you count the one that's going to close on September 8th, probably 20, 21 maybe.
Okay, that's quite a bit. That's good. I don't know if you're much of an economics person, but do you have any sort of outlook on where the market's going?
Anytime somebody asks that, I always tell the story about my favorite economist, Dr. Ray Dotzauer. He's retired. But he used to be the chief economist at the Texas A&M Real Estate School. I got to hear him speak one time at the GREA conference, and he came out on stage and introduced himself and said, for those of you that don't know me, I'm Dr. Ray Dotzauer. I'm an economist. What that means is that 50% of everything I say is wrong. I knew right then I loved the guy because he was funny. He was very insightful. He went on to give a history of why we're at where we're at and what to expect. Anyway, I say all that to say I don't know. I do have a crystal ball. Unfortunately, it's full of mud. But my sense is that we're at the bottom of the market. I don't think we're going to bounce, meaning that it's going to go back up. I think we're going to have a slow, hard slug to climb back out of where we are and get back to a normal real estate market. And maybe we never get back to whatever. We may have a new normal. I don't know. But I get the feeling that whatever's going to happen over the next year to 18 months isn't going to happen quickly. I could be wrong. I hope I'm wrong. I'm hoping it goes up like a skyrocket and then I can sell all my assets and then you won't see me except with like pictures like this in the background.
Yep. Yeah, I was talking to Sam Morris and he's just now buying his first deal. He's now with Lone Star Capital and they're just buying the first deal this year. And he said that he has been outbid by a number of institutional players that have been holding on to their cash, trying to buy, and now they're finally like back in the market buying.
Yep.
And yeah, so it sounds like institutions are coming back and they have money to spend. And yeah, like they raise all these money to wait for the market to bottom so they can swoop things up but it's
Yep.
yeah, they haven't been able to do that. So I think they're done waiting, so they've started to buy. All right, Shawn, you mentioned about the fund of fund strategies, and at first I kind of misunderstood. I thought that you are now doing fund of funds into other people's deals, but now I understand it's the other way around. You're teaching other people how to start their own fund of funds to invest into your deals. Is that correct?
One of the things that we're always trying to do is reach out and help others that aren't as far along the path as we are. And whether that's in syndication or in capital raising, we want to be able to encourage people to go, hey, look, this is an opportunity. Here's how you can work with us and raise money. And that's knowledge they can take and raise money for anybody anywhere. We're not saying, oh, you can only raise money for us. We're freely giving that knowledge away to people that are interested. Now, I will clarify that a bit and say that we typically only work with people that are fairly high net worth. And if they're going to commit to a $500,000 for their first raise, that they can write a check for $500,000 or close to it, right? Because we all know if most people that have never raised capital before and haven't been exposed to a lot of high net worth individuals, if you think you can raise $500,000, good luck. I wish you the best. but in reality, you're probably not going to hit that mark. And if everybody on the team is realistic, they realize that, okay, we'll give you a chance. We'll let you do that, but we're not going to plan on you hitting that mark.
Yeah. Yeah, and if they don't hit that mark too, like they also waste a lot of money in legal costs and things like
Mm-hmm.
that. And so yeah, it makes sense that yeah, they commit to what they can actually perform. So
Yeah. That's part of the
right.
education too, is to let them know, hey, this is why we think you need to have 400 to 500K as an initial commitment, because really, I think right around 400K is break even.
All right, Shawn. For those, we're gonna wrap up this part of the show, and then we're gonna open up for Q&A here. For those that wants to reach out to you, connect with you, learn from you, maybe raise capital with you, or even pitch them their deals, where would you like to send them? I
They
see
can
you.
check out our website. I'm going to put it in the comments here if I can type. It's craftcapitalinvestments.com.
Okay. Yeah, and yeah, Shawn's email and phone number is also in the chat there for you guys. Make sure you get that.